Anyways, we've talked a lot about present and future of tech and innovation, but now we're going to shift our focus again to the macroeconomy. And once again, make sure to submit your questions for our speakers using the Forum app. So we're fortunate to have Jonathan Coslet join us today. So he's a member of the Wharton class of 1987, who retired as a senior partner with TPG earlier this year after a 32-year tenure with the firm, having started in 1993 as TPG's first investment professional. And I actually fortuitously sat down next to him last night during the presentation. He's just a remarkable person. I'm excited for you all to hear his insights. He'll have a conversation with Bilge Yilmaz, the Wharton private equity professor and a professor of finance. They're here to put some things in context for all of us. So without further ado, enjoy.
Okay, good afternoon, everyone. Today, I'm going to be speaking with Jonathan Coslet about the US economy and the markets. Jonathan is obviously, as all you know, a graduate of our undergraduate program many, many years ago, and he's been a great friend of the school. In fact, Jonathan and I, we've been hosting these kind of events in my classes and part of the Wharton Alternative Investments program. And we have the opportunity to obviously have many conversations on the impact of macro and investment environment. And we've been having these conversations. And so after years of stimulating conversations, Jonathan prepared some slides to go along with our discussion after we spoke about this topic. So we have about 45 minutes to discuss the incredibly uncertain environment that we are all living today. So let's get started with our questions. At the end, hopefully we'll have time to take a few questions from the audience as well. So Jonathan, there is a lot to talk about economics, markets, and especially nowadays geopolitics. Let's first start with the economy, the macro outlook. After coming out of COVID with a lot of stimulus that led to a strength and relative prosperity, the world is once again quite uncomfortable and unpredictable. Some of it is US making, some of it is not. And the highly unorthodox approach of the Trump administration has added quite a bit of uncertainty to the geopolitical and economic environment around the globe. As you think about the last 40 years of your career in business and finance, what have you learned that could help us to organize our thoughts as to how business leaders and investors can navigate the current environment?
Thanks, Bilge. Thank you guys all for coming to the Wharton Global Forum. I'm really excited that we're here in San Francisco. I was just remarking to Bilge that even though I'm a Philadelphia native, I've now spent more than half my life in San Francisco and the other half in Philadelphia. And it's great to have Wharton out here. I mean, we're lucky to have Wharton West out here, and that presence is growing. But I believe that San Francisco, the Bay Area, is one of the top 1, 2, 3, 4 most important cities in the world for business and for economic prosperity. So it's great that Wharton's here, and I hope that we can continue to have our presence grow here. Thank you, Dean James, for inviting me. And maybe the quid pro quo is that we have to have a Wharton Forum in San Francisco no more than every 10 years. It's been 11 years since the last one. We got to have one at least every 10 years. We got to be in the top 10 cities for sure in the world. So thanks, Bilge. Let me first talk a little bit about economics, then I'll kind of blend in some things in the market and geopolitics. When I first walked down Locust Walk in 1983, we were just coming out of the worst economy since the Great Depression. The economy of the late 70s, early 80s, the stagflation that we had then. We had a 20% federal funds rate and 15% inflation and 2 very difficult recessions back to back in the late 70s, early 80s. And since then, we've had one of the greatest economic booms in the history of all time. Of course, with a few setbacks along the way, like the great financial crisis, the dot-com bust, and COVID. But generally speaking, it's been an unbelievable economic boom. And as we think about where we are today, let's start by remembering that we all have lived through, in the last 40 years, what I believe is a once-in-a-history decline in the cost of capital. None of us will ever see this again in our lifetimes because it's very unlikely that we'll have a 20% federal funds rate, 15% US Treasury anytime soon. So as we think about where we are today, let's remember that we've had an economy that's been based on that huge reduction, continual reduction in interest rates over the last 40 years. That's really been one of the key drivers of the success of the last 40 years. And from the past, we know that economic growth is driven primarily by three factors. Number one, demographics, population growth, the composition of population, immigration trends. Number two, productivity improvements, driven by technology innovation, the steam engine, electricity, the computer, the internet, and government policy. At the highest level, the choice between capitalism and socialism and communism. At the more specific level, fiscal, monetary, tax, policy, etc. And let's start a little bit with demographics. We have to recognize that today demographics is working against us. We have longer lifespans for the elderly. We're having fewer and fewer babies in the United States, and particularly in places like Japan, Korea, countries in Europe that aren't even replacing their population. And that means more healthcare resources like Medicare, more retirement resources like Social Security, and the workforce will have to support those higher and higher numbers of people that aren't working. This is a trend and a headwind that's happening all over the developed world. Even in China, which we think of in some ways as a young country, it's really not from a demographic perspective, partially because of the one-child policy that they've had for so long. They're having these same issues. The old saying is, China needs to get rich before it gets old. And that's an issue that they're going to come up against as well. And of course, lower immigration into the United States will aggravate this problem. And fortunately for all of us, we've had incredible technological innovations over the last 20, 30, 40 years. That's been able to help us overcome some of these demographic headwinds. Semiconductors, computers, software, robotics, cell phones, the internet, they have really fueled the growth and productivity that we've been able to accomplish despite the demographic headwind. And many of us have lived much of our lives without the internet. We've experienced the profound impact of what's probably the most important and most powerful technological innovation since electricity. The internet is always on, it's perfect connectivity, nearly the entire population, and it's turned a physical and analog world into a virtual and digital world. And 40 years ago, less than 1% of the world's population would have any contact with someone outside their home country. Today, it's 70%. So that's been a huge driver to powering globalization of the world economy. And with the United States being the premier innovator, the US has benefited the most from technological innovation. As you can see here, we've far outpaced the productivity of the other developed market countries. And now we have what's been talked about a lot so far here today, artificial intelligence. It's very early days, but it's coming quickly and very, very powerfully. And of course, as you talked about, and we talked about in the last session, we understand that AI will change our approach to work and improve productivity in areas such as software and data analysis, education, healthcare we just talked about, and so many others. But we also realize that AI will have a profound impact on human employment, not just on the lower and manual processes, but also on higher skilled jobs like finance, legal, accounting, and even, as you heard in the last session, physicians. We could obviously spend a whole day talking about the pluses and minuses of AI, and there's a lot of sessions today that are on that. For now, let's suffice to say that AI will have a profound impact on so many factors of our lives. It's both exciting and frightening. Exciting and frightening. And it's really important that all of us learn as much as we can, as quickly as we can, about AI, its implications, its applications, so that we can live on the good side of AI's evolution.
So along with government policy, which we'll save it for later, I mean, you're quite convincing that demographics and productivity and technology drive driving force behind the economy for the long term. But obviously, long term, we both may not be here, unfortunately, Jonathan. So let's
Speak for yourself.
Well, Jonathan and I were 3 years apart, but I won't tell you who's older.
Well, you look a lot younger than me, so.
Thank you.
It must be that stressful professorial job.
Yeah, but I do things that shorten my lifespan. I go against the dictators in the world, so who knows?
That's true.
We'll find it out.
I just make fun of the dictators in the United States.
Now, with that said, let's talk about the United States in the short run. We are here in 2025, and it seems like every day there is something new. Just what's happening out there?
Yeah, well, obviously a lot has happened since Inauguration Day for President Trump only 6 months ago. And from an economic perspective, his obsession with trade has been the most important new issue that we've had to digest. We've always thought of trade as free trade as being the thing, and now we've got to think something else. And when he launched Liberation Day, immediately projections for a recession in the United States rose to over 50%. The chaos has subsided a bit over the last month or so as he's been focused on other things. And recession probabilities have come down to something in the 30-35% range when you survey most economists. I would say I was reading a report today from BCA, which I believe is one of the best independent research firms, and they still have a 2/3 probability that the US will go into a recession in the next 12 to 18 months. You know, since Liberation Day, first the soft data came out. Soft data is like survey data, and it's been weak. Consumer sentiment down, business sentiment down, CapEx intentions down. Interestingly, retail sales have been holding up so far. Some of that might have been pull forward for fear of tariffs. And actually, just recently this month, we saw some retail sales data, which was actually the first sort of tick down that we've seen. Housing activity, which is critical for the economy, is down. And corporate earnings, they've been very strong. The first quarter was up 13%. But some of that strength, as I said, was, I think, pull forward of demand to get in front of tariffs. And estimates for the year continue to come down. And all of that has led to GDP forecasts being marked down to something in the 1-1.5% range for 2025. And as we think about our starting point from this point forward, we have to remember that the momentum that we've had in the economy, we're coming off a huge injection of fiscal and monetary stimulus that got us out of COVID. $6 trillion was injected by both in fiscal, it was actually $6 trillion of fiscal, putting aside the trillions of dollars that was put into the economy on the monetary side, quantitative easing. And this spurred a lot of excess spending. First, it came on the good side, and then later, services came along. But now, we've got a household that has essentially spent down all of that COVID savings. They've spent it down, and they spent it quickly on vacations, on cars, on other things. So as we move through 2025 and 2026, we have to remember that the momentum will naturally slow just because of this spending of what was artificial stimulus and artificial savings. We have also got to remember that international flows into the United States have been enormous, absolutely enormous. And as that mountain of liquidity starts to dry up a little bit, as foreigners feel less comfortable spending and investing in the United States, that's another thing to consider in terms of the economy over the next couple of years. We're already seeing it. Fewer Europeans are traveling to the United States. The dollar is weakening, which makes it less interesting for foreigners to both invest and to spend in the United States. And there's a lot of factors to talk about.
I think one factor that is really important we haven't talked about is the labor market. So what do you think is going to happen or has been happening in the unemployment rate and the real wage growth?
Yeah. Well, as you can tell from some of these charts, I like looking at things over a long period of time. And unemployment's a really interesting cycle, as you can see here. The unemployment rate troughed at about 3.5% in 2023. Since then, it's ticked up to about 4.25%. I think when it comes out in the next couple days, it will tick up again by another 1/10 of a percentage point, plus or minus. But what's fascinating about the unemployment rate, at least historically, is once it inflects by some amount, let's say 50 basis points, it typically begins a real continuing trend. I mean, look at those charts. Nowhere on that graph do you see a flat line. You see it either going down, 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 then it inflects and goes up, 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 and then it inflects and goes down, down, down. There's not a lot of flatness anywhere, at least historically. And, as we look at the jobs picture today, the labor market was very tight after COVID, but today the jobs market is clearly slowing. Layoffs are rising. The non-farm payroll numbers have kind of ticked down to about 150,000 per month, and that's about the rate that will hold the unemployment rate flat. So anything under that, you start seeing unemployment start ticking up. And with slack in the economy and in the employment markets, wage growth is slowing now to under 4%.
So the job market is definitely softening. I think that's clear. But what other areas we should be looking at in order to evaluate the health of the U.S. households and their future?
Well, housing is the biggest expense of every household. And as you can see, as mortgage rates have ticked up, housing is becoming more expensive. And households really feel that. The other thing is, as stimulus savings have been spent down, we're also seeing consumer credit quality starting to worsen. And deteriorating credit quality is often the most prescient sign for an economic slowdown.
So this doesn't look too good. So do you see any bright spots at all for the consumers?
Yes. Perhaps the most helpful factor for the health of the U.S. economy is that household leverage has actually improved hugely since the great financial crisis and again after COVID. Today, U.S. households own $200 trillion of assets and $20 trillion of liability, and overall debt service to income ratios are low. Now, income and wealth inequality have been rising throughout this whole period. So while I show this chart as a real positive, there's huge differences between the health of the upper quartile households and the lower quartile households and even the middle households. There's a huge disparity that continues to grow in terms of the health of the households. But this is really, really important because as we know and as we'll talk about, U.S. federal debt has been rising through this whole period. Corporate debt has been rising through this whole period. And it's really hugely beneficial that household leverage has come down as much as it has. And it's probably the most important saving grace that we have.
So the other thing, obviously, that is really important and a lot has been happening on is the inflation. For years prior to COVID, especially in the developed world, we thought that war is over. If anything, we were worrying about disinflation in some of the large economies. But after COVID, I guess reasonably so, after such a big stimulus, especially monetary stimulus, We saw very high inflation, starting especially around 2021, 2022. Obviously, along with the stimulus, we had production and workforce shortages that created supply problems. So that, I think, has been well taken care of with good policy. But now we're looking at this uncertainty of tariffs. What's going to happen?
You know, the worst economic scenario, and the word that's being used over the last 3-4 months, is stagflation. So that's a recession combined with inflation. Very, very difficult to deal with, as we saw in the mid-late 70s and early 80s. And I think the Fed did a very good job sort of holding down inflation by raising rates in 2023 and 2024. And inflation is coming down to under 3%. I just saw some specific data that said goods inflation is now close to 0. That's before tariffs. And services inflation is about 4%, plus or minus. So overall inflation is a little under 3%. So the Fed did a good job so far. But that's before the impact of tariffs. And we know that since Liberation Day, with the prospects of higher important tariffs, expectations for inflation have been rising. And even the Fed, in their meeting 2 weeks ago, June 19th, they actually increased their inflation expectations due to concerns over higher tariffs.
Obviously, the inflation causes Fed to increase the policy rate, and therefore inflation actually determines the interest rates indirectly. And the Fed took the rates up to 5% from 0 very quickly to fight the COVID inflation, as you pointed out, very successfully. But since then, although we are not at our target rate yet, the rate is down to 4%. So where do we go from here, especially given what you pointed out about the U.S. deficit and the accumulating debt?
Yeah, well, again, I start with this sort of very big picture here. This is real rates, so nominal rates less inflation, and a very interesting chart. You can see that thanks to quantitative easing, a very dovish Fed, since the great financial crisis and through COVID, real rates declined to be negative over the last decade. So rates weren't just low, they were actually negative, which essentially means it pays to borrow. So it's no wonder that the economy and markets have soared over the last 15 years since the great financial crisis. Even today, the real rate is about 2%. That's still relatively low historically and pretty stimulative. And, Trump continues to implore Jay Powell to lower rates, right now. And when the Fed met on June 19th, they modestly reduced GDP forecasts. They modestly increased their inflation forecasts. And this is a real conundrum. A weakening economy with higher inflation is a very tough place from which the Fed can act decisively with any view. And interestingly, there was a pretty big split in the FOMC on June 19th. About half the members expected no rate cuts in 2025. But net, you kind of pulled it all together and you look at the dot plots, and the Fed and markets do project that rates will come down over the next year or so as the economy is expected to continue to soften, and with the hope that inflation will stay under control. And now the new factor is Chairman Powell's term is up mid-year next year, and President Trump is already talking right now about announcing the replacement for Chairman Powell, essentially trying to put Chairman Powell in a bit of a lame duck position. And we know that if President Trump is choosing the next Fed chairman, it's going to be someone who's probably much more dovish than Chairman Powell. So that's going to be really interesting to see. And in the medium term, we need to think about this chart, the growing problem of our national debt. We've been ignoring it for a long time. It was about a decade or so that there was this bipartisan commission that came up with reforms. There was a lot of buy-in, but nothing ever happened. So today we have $36 trillion of U.S. federal debt. over 100% of GDP, and it's still growing. And we haven't seen these debt to GDP levels since we had to fund World War II. And this huge increase in debt has occurred despite a really strong economy. In fact, in some ways, the really strong economy may be because of the increase in debt that we've taken on. So this is the consequence of all the things that we've talked about: huge Fed easing, negative real interest rates, and the American people, through taxes, through Social Security, through Medicare challenges, Medicaid challenges, are going to have to ultimately pay for it. That's, our children and our grandchildren, unless we figure something out. And, when you look at the actual annual budget, it's about revenues about $5 trillion a year and expenses of about $7 trillion. So this year we're going to have a $2 trillion deficit. And unfortunately, much of that $7 trillion of expenses is non-discretionary. It's Medicare, Social Security, defense, and interest payments. There's only $1 trillion that's discretionary in any real way. So we would need to have meaningful reform, particularly in Medicare and Social Security, to solve this problem. And in the recently passed one big, beautiful bill in the House, which the Senate is now getting ready to try to approve, Congress once again will increase the slope of the debt. It's amazing that a Republican Congress is in the position of actually increasing our deficit as opposed to the traditional philosophy of tighter government spending. And the Senate doesn't seem to be making any progress. The most recent scoring of the Senate proposal also has debt levels increasing even higher than the House bill. And something looks like it might get passed or get signed before July 4th or soon thereafter. And as we think about debt, again, long-term implications that we just sort of ignore most of the time, this is a real vulnerability for us. China is the second largest purchaser of U.S. debt, and they have slowly but surely started to reduce their purchases. And that's a very powerful economic and political lever that they hold in their relationship with the United States. And also, sort of under the covers, other countries, particularly Japan, which is our number one purchaser of U.S. debt, has also, for the first time in 2025, started to scale back their purchases of U.S. debt. So, we've got a real medium-term issue on the debt side.
So we haven't even talked about the tariffs yet, and I think that's the elephant in the room. So this is the most controversial element of the economic equation going forward for us. So what do you think about the tariffs?
So I think we were all surprised, I guess is the right word, at the tactical approach that the administration took to tariffs. We have $3 trillion of exports annually, $4 trillion of imports, and the combined flows of exports and imports together is almost 20% of sort of the economic flows of the United States annually. And it's interesting, over 80% of all economists, when you survey them, say, regardless of their party affiliation, say that they believe, complete free trade is the optimal policy for economic growth and prosperity. So why is President Trump so obsessed with raising tariffs? He's been at this for a long time. He started in his first administration. Last year, the United States had a $1 trillion deficit, trade deficit, up from, that's again another $1 trillion of capital that somehow we need to borrow. And that's up from $100 billion in 1990, so 10x. And the largest contributors to that are China, Mexico, Vietnam, Ireland, Germany, and Taiwan for the semiconductor chips. And this chart, which is hard to read, it's got on the y-axis the tariffs that other countries impose on the U.S., and on the x-axis the tariffs that we impose on those countries. And these are kind of average tariffs because there are product-by-product differences in every country. You can see that this does remind us that many of these countries do charge us higher tariffs than we charge them. The real issue is China, $300 billion trade deficit, and President Trump believes strongly that we need to reverse this trade deficit. Even though some of the trade deficit, irrespective of tariff levels, is caused by the fact that there are some places where goods are always going to be produced more cost efficiently than in the United States. If we raise the tariff on Vietnam enough, we'll start making more sneakers in the United States. And that'll be the result of having a tariff on Vietnam, higher tariff on Vietnam. And when you look at the initial salvo of the Trump administration, this is before the multiple increases. The initial salvo would have increased tariffs across the world from 2% last year to 14. Actually, it's probably 15 or 16% now when you do the calculation on average. And we now have a framework agreement with China that I guess President Trump just signed either yesterday or today, I think I read. And that sets the tariffs on Chinese goods at 55%, while China's tariffs on U.S. goods would be 10%. And China has agreed to supply rare earth magnets to the United States, which is a big win for the United States. It seems odd that China would agree to this. 55% is a big headwind to imports into the United States from Chinese goods. It's definitely going to make Chinese goods more expensive. It's definitely going to lower demand for Chinese goods. But this is also a framework agreement. There's not really a lot of detail that has been disclosed. And one interesting little thing that's not talked about is this rare earths deal is only 6 months old. It only has a 6-month duration to it. So in 6 months, there's going to be another discussion about the rare earths deal. And President Trump has signed this framework agreement. The details need to be ironed out into a full agreement. President Xi has not yet signed the agreement yet. So we'll see. It's very interesting. We'll learn a lot over the next month. There's this July 9th date at which all the tariff deals are supposed to be done, or else President Trump is going to, quote, send a letter to every country telling them what their tariff is going to be. That's on July 9th. More and more, it feels like we could wind up in a okay place with reciprocal tariffs of something like 10% with most countries, and maybe sort of a fragile deal with China, which makes Chinese goods more expensive, but at least creates some stability so we can kind of get beyond the uncertainty and move forward, albeit with higher costs for Chinese good, which is going to hit U.S. households' pocketbooks unless companies decide to take it in their margins. And it'll be some combination of both.
So now we're in the crystal ball part of our conversation. So what's going to happen with the equity markets? So far, it's been a very tough, volatile spring. So as an investor, as an equity investor for so many years, decades, what are you thinking about the equity values now?
Again, I start with this big picture. It's really been an amazing time for equities. I think all of us whose career has lasted the last 30 or 40 years, we've been really, really lucky, despite the great financial crisis. Look at this chart coming out of the great financial crisis, sort of somewhere in the bottom, with 2009 as the bottom. Since the peak in 2007, before the GFC, equities are up 4 times. Since the trough in 2009, equities are up 8 times. A lot of what has driven that is this continual reduction in long-term interest rates and real rates, and the immense amount of, I think it's on the orders of $10 trillion of liquidity that was created by quantitative easing. And, in 2005, like just 20 years ago, if you had asked any of us, how much would the stock market be up sort of 20 years from now? I don't think we would have said 5x. So it's been a really, really good time for equities. And, today I think we just hit all-time highs on the stock market again, which is pretty amazing given all the things that are going on in the world, both economically and politically. And, some of that strength has been driven by this term U.S. exceptionalism. There's been a flood of capital coming into the United States stock markets from other parts of the world. And you look at that outperformance of the United States, it's really incredible. The US now accounts for 70% of the entire global stock market value. And despite all of the academic recommendations to be diversified, diversifying your equity portfolio outside of the United States, particularly diversifying into emerging markets, has not been a good thing over the last 20 years. But for the first time in a long time, in 2025, we are now seeing the international markets, the European market, interestingly, starting to outperform the United States. So it's going to be interesting to see going forward whether this flood of capital into US markets will start to roll over and turn over. And from a valuation perspective, we currently stand at over 20 times next year earnings. That's not far from the peak levels at the dot-com boom in 2000. Other world markets, they trade at about 14 times for every dollar of earnings. That's about 1/3 less than what we trade for in the United States. And when interest rates were zero and the economy was growing, 20 times felt fair to me. Does 20 times make sense if rates are elevated, if the economy slows? There's certainly not a lot of upside on the multiple side, so any appreciation is going to have to come through earnings. So it's all about your forecast for earnings over the next 2, 5, 7 years. And my sense is that earnings will not increase at the rate that they have over the last 5 or 7 or 10 years. So I think we need to be prepared for much lower growth in equities over the next 5 and 10 years. Here's another way to look at stock market valuations. This is, they call it the equity risk premium. It compares the earnings yield from stocks, so that's the inverse of the PE. So 5-ish%, inverse of 20, and it compares that to the risk-free rate, something in the 3.5-4% level now. And as you can see, the equity risk premium has been compressing for quite a while, and that makes stocks less attractive relative to bonds. And here's a chart that, again, really fascinates me. This is the 10-year rolling average returns for the U.S. stock market over the last 100 years. So the 10-year annual returns. So you can see that, interestingly, over the last 100 years, there's been only 3 times where the 10-year annual return has been negative. That is, we've had better than 0% annual returns for a 10-year time period. The last being the period that started with the dot-com bubble burst in 2000. You might recall that Microsoft, one of the unbelievable companies of the world, it took 15 years after 2000, all the way to 2015, for Microsoft's stock price to get back to where it was on January 1st in 2000. During the good times, the 10-year averages sort of approached 20% annually. So here we are today, with a 10-year annual return of sort of got as high as 15, 16%. Now it's at about 14%, sort of close to peak levels, but seemingly past to peak. And this is a lot about the psychology of human behavior, about how economies, businesses, markets get exuberant, too much capacity is created, too much supply is created, then the economies, the businesses, the markets realize that supply has to be reduced, capacity has to be reduced, things are overvalued, and it goes the other way. But it's fascinating to think over the last 100 years, it's been sort of 4 very distinct cycles, and we're kind of now towards the top of one of the cycles.
So, you took us through a lot of important points, Jonathan. So let's kind of bring it all together, summarize it. How would you actually think about the, say, next 1 or 2 years, and perhaps up to 5 years? What is waiting for us?
As an investor and as a businessman over the last 30, 40 years, I think for all of us, I think what we've learned is it's almost impossible to predict the future. When I think back Obviously, no one would have predicted COVID would shut down the world, that there would be something like COVID that could shut down the entire world for a year, 18 months in some ways. And 10 years ago, plus or minus, when President Trump walked down that escalator in Trump Towers, like a month before that, I'm not sure that anyone would have predicted that President Trump, Donald Trump, would be a two-term president in the United States. So the one thing that I know is I don't know the future. And whatever we see today, we have to always know that the world is incredibly dynamic and incredibly unpredictable. So we better think about all the scenarios. We better make sure we have sort of a balanced and somewhat hedged perspective on both the upside and the unknowable downside, the black swans that sometimes occur, and be positioned accordingly. So I think about the short term, I'm focused on really these three issues. Number one, the resolution of tariffs. Lower is better on both sides. It's not going to be good if we experience rising input costs, reduced demand on the export side. And as I said, it feels like we're moving in the right direction. Not counting my chickens just yet. I really need to see the details of the China deal, the details of some of the deals, to have a sense for how much inflation and how much demand destruction is in the tariff deals. But it feels like we're kind of inching towards something that's much less worse than we thought it would be. On the inflation side, the question is, can we avoid the stagflation that could come from higher tariffs? It feels like inflation will be a bit higher. Not the 2% that the Fed is targeting. It might be 3.5%, 2.75%, but still under control, I think, assuming we get an okay settlement around the tariffs. And then on interest rates, will the Fed have the resolve to lower rates if there's more economic softness without the fear that they're going to be stoking inflation? Feels like rates will slowly tick down, may take a little longer than President Trump would like. But in 2026, we're going to have a new Fed chair, and it's going to be chosen by President Trump. So I think it's highly likely that we're going to get more rate cuts under that chair than we've had under Jay Powell.
So with all of that, should we expect a recession?
I start by saying I am not an economist.
That's why I'm asking.
Are you an economist?
I guess I qualify for one.
You qualify, so we should be asking you that question. But I think the real question is, can we achieve the highly, highly elusive soft landing? The last time we sort of had a soft landing was 2001, 2002. Technically, we actually did have a short and shallow recession in 2001. We actually did see earnings go down in 2001 quite a bit. They bounced back in 2002. But over the 2-year time period of 2001, 2002, we did have something that was close to a soft landing. The Fed gets a lot of credit for that. They were very accommodating right out of the box in 2000, late 2000, early 2001. Now, unfortunately, their prolonged easing ultimately was the cause of the bubble of 2005, 6, and 7 that led to the great financial crisis. But assuming no more geopolitical surprises, which I'm not sure we can make that assumption, or at least putting those to the side for a moment, and assuming tariffs get worked out in this sort of 10-ish% for most countries and something that's not too harmful on the Chinese side, I actually believe we could have something sort of like a soft landing. Better than even odds, maybe 60%, which it would be historically very unusual to accomplish a soft landing. Hasn't been done really at all over the last 100 years. But the Fed does have a lot of room to continue to ease. The economy is a lot more balanced than it typically is at this point. It's a lot healthier than it normally is at this period. Things have been coming off the COVID top slowly but surely. The The pressure's been being let out of the balloon much more slowly than it normally would, like in the great financial crisis. And as I said, we're going to have a new Fed chair, and they're going to be more dovish than hawkish. Actually, the one big beautiful bill, while it increases deficits in the back half of the 10-year time period, while its savings are mostly towards the back half of the 10-year time period, the first half is actually a little stimulative in terms of the tax reductions, tax cuts, and the other spending that is in the bill. So I actually might be more constructive than you take away from the charts. I mean, I think the charts lay the groundwork for kind of where we are today, but my instinct actually is that we could pull off something that's not too uncomfortable. And we look out further, kind of in the medium term. I just want to reiterate these two big things kind of for the medium term. AI, the biggest, newest big thing. It's going to have profound impact, both positive and negative. It's going to be very unpredictable. But what we know for sure is 5, 7, 10 years from now, our economy is going to be a lot different. The world economy is going to be a lot different than it is today. Think about the internet, how the world changed from 1990 before the internet to 2000 after the internet. Just a huge, huge change. And again, U.S. debt, can we slow the pace of the growth in the federal debt? This is still the biggest long-term challenge that we have for the U.S. economy, and it's very, very hard politically to reform Medicare and Social Security. And then all this that we've talked about has been economics. We haven't been talking about, what's going on beyond economics. We have an incredibly volatile and incredibly unpredictable geopolitical situation, and anything and everything could be destabilized at any moment. Interestingly, historically, the markets have been generally pretty, and the economy has been generally pretty resilient to conflict, global conflict, even wars. But it depends how deep and dangerous things get. So for now, for me, the better part of valor as an investor and as an allocator of capital in businesses is to be patient, be calm, and protect. When the world becomes more clear, which it will at some point, there's plenty of time to lean into the future on the upside. And, to me, it's very strange. We have 8 billion people in this world. We have almost 200 countries in this world. That so much rests in the hands of, really just a few individuals. And that man in the middle holding the world, who's not shown there, but we know who the man in the middle not holding the world is. And it's really hard to believe that in 2025, with all the progress we've made around the world in so many different things, that this is where we are today. It's certainly a very uncomfortable and unpredictable time. But, as my grandmother once said, or always said, this too shall pass. The history of the United States, this country of huge scale, entrepreneurship, innovation, and repeated resilience has been one of growth and prosperity consistently. The United States has so many advantages, particularly its scale, particularly its innovation in technology. And growth over the medium and long-term growth and prosperity will continue for sure. We're going to have ups, we're going to have downs, but it will continue. And I'm still betting very positively on the U.S. economy, the U.S. markets, and America.
Thank you, Jonathan. As always, it's been a great pleasure having a conversation with you, very enlightening. I have promised that we'll take questions if time permits. Well, time doesn't permit that much, but...
We got a break. We can take one or two questions.
Yes, that's what I was going to suggest. There are a number of excellent questions in front of me. So I will start with the most popular one. So people had supported this question the most. Today, the markets hit an all-time high. The same day, the President of the United States suspended trade talks with Canada. Given the macro data that you were presenting, what is driving the markets? Is it the interest rate expectations?
I think generally, yes. It's the expectation that interest rates are going to continue to come down. As we talked about, the expectation that the tariff situation is going to get worked out. But that still leaves an overall valuation question mark for me, just given how high, we're in top decile valuation measures. Doesn't matter whether it's price to earnings or enterprise value to sales or enterprise value to cash flow. We're on top decile earnings at a time when economically the United States in particular is slowing and the world is pretty messy. But yeah, I think it's mostly interest rates.
And this is the next question and the final question of today is really for a private equity investor. Obviously, you've been a very successful investor for decades. So where are you seeing silver linings or underappreciated growth stories in the global economy?
Well, the great thing about all this innovation that's occurring is there are many, many pockets of incredible growth and prosperity. Obviously, we talked a lot about AI, but it's not just the technology of AI, which will become a commodity at some point. It's the implications of AI to businesses. You know, first thing that will happen is that many, many businesses will become more productive, more efficient, and margins will go up. And the second thing that will come is some of those same businesses will start to get commoditized and margins will come down. But there's a ton to be thinking about with respect to AI. There's a ton to be thinking about with respect to healthcare, not just from the AI side. Of course, the aging of the US population, the aging of the world population means that demand will just continue to grow for healthcare services around the world for a long, long time. And that demand will mean that anything healthcare related will have a tailwind behind it. And the services that are being created, the technology for drug innovation, for therapies, cell therapy, gene therapy, they're unbelievably revolutionary. So there's many, many really cool places. And then I think this whole notion of convenience, I put this slide pack together with the help of an online, graphics PowerPoint producer. And, I went to this, it's called Upworks, and it's a marketplace for freelancers who do all kinds of cool things. And there's just an incredible ability. People want more convenience. Time is our most valuable asset. And there's a really interesting ability to create convenience, to create point solutions for specific problems that we have as consumers, as individuals. So there's tons of really cool places to invest.
Great. Thank you again, and thank you all. And
thanks,
hopefully,
Bilge.